I was in your shoes just a couple years ago. I didn't know much about all of this. After all, the financial industry is designed to confuse you, since advisors only make money off the fact that you don't know what you're doing. I'm sure you can find all the information in this video in a million other places scattered across the internet. But only here will you find literally everything you need to know in one place, explained simply and quickly. No BS. You are saving yourself years of headache just by watching this video. I promise you that. This video is 2 hours long because it has to be. There is a ton of information we need to cover. If you want a brain mod 30-second version, go scroll reels instead and miss out on the blueprint to making millions. If you choose to leave now, you are choosing to be poorer. That isn't a threat, it is a mathematical certainty I will prove. You'll have an incredibly advanced knowledge of everything to do with index funds, so you can make sure your money is reaching your full potential. For example, I will show you how people burn money each year simply because they have the wrong setting turned on in their brokerage account. I will show you why people who think they're diversified are still doing it wrong. I will show you the silent killer of index funds that will steal hundreds of thousands of dollars from your retirement. I will break down literally every single misconception people have about investing and prove them wrong. I am not going to waste your time. I'm just going to be spitting straight facts, and it's up to you to use this information to make millions. This video is divided up into 10 big sections, with each one covering absolutely everything about a certain subject. It all builds on top of itself, so do not skip ahead. Sections 6 and 7 are the engine of this entire strategy. I'm not even making a 6-7 joke. You must stick around for them if you want the whole operation to actually work. For example, in section 6.9, I'm going to show you a specific 7-step algorithm to construct the mathematically optimal portfolio for you. Obviously, this video is a beast. It's basically a full college class for free. Hit the save to watch later button right now so you don't lose this resource. You can revisit it later and finish off the video if you had to take a break in the middle. Treat this video like a reference book that you can come back to anytime you need. So grab your notebook and let's get started. Time to lock in. So why do we care so much about investing in the first place? Just imagine this. If you don't invest diligently, you'll find yourself in a trap that so many people are stuck in. It's way too easy to fall into the default cycle of working, spending, and ending right back where you started at the end of the month. No actual growth can occur. Since inflation takes away your purchasing power every year, it's like a melting ice cube. Your money will just slowly fade away as time goes on. Therefore, even if it's just a little bit, investing will help you escape this since your money passively grows over time. You're doing this so that future you can live better. You could gamble your life savings on RainBet to get more money, but we all know how that's going to end. Instead, index funds are probably going to be your best bet. See what I did there? Since I'm not here to waste your time, let me show you how the math proves that clicking off this video is $1 million mistake. You have one asset right now that any billionaire would kill for: time. And time is the fuel for what Warren Buffett calls the 8th wonder of the world: compound interest. Let's run a simulation. We have you. You're 20 years old. You just put $100 a month into index funds. And then we have Wojak. Wojak thinks he's too cool to invest right now. He waits until he is 30 to start putting in the same $100 a month. Fast forward a bit. By the time you are both 65, Wojak has $230,000. Not bad. But you? You have $526,000. Here's the crazy part. To get that head start, you only had to invest an extra $12,000 total if you do the math. That's the price of a used Honda Civic. But in exchange, your account grew an extra $300,000 compared to his. You effectively traded a used Honda for a brand new Ferrari, just by starting 10 years earlier. That's the power of compound interest. It turns time into luxury. But it gets even better. Let's say you both start at 20. Wojak just presses the buy button on some index funds and hopes for the best. But you watch this video and know about all the little ways you can optimize your portfolio's profit and get a 2% higher return than he does. That tiny 2% difference doesn't sound like much, but over a lifetime, while Wojak retires with $526,000, you end up with over $1 million. Same monthly deposit, same time frame, but you retire with double the money just because you watched this video and learned how to optimize the system. This information is literally worth $500,000, so do yourself a favor and stick around. So yeah, index funds. They're funds that track an index. No way. Let me just explain what they are real quick in case you don't know. If you already understand them, you can skip to this timestamp, but I would recommend just watching it. It'll probably still be helpful. Let's say I really like Nvidia stock and think it'll do well over the next decade. However, if I invest only in Nvidia, I'm putting all my eggs in one basket. Jensen Huang could decide to tweet that Nvidia stock is too high and it would go down 50% in one day. You're too concentrated in this one specific company. Obviously, that's a good thing when they're doing well, but as soon as things go wrong, you have the farthest to fall. And who's to say that Nvidia will be the one to perform the best? Cisco was the Nvidia equivalent 25 years ago. But if you bought Cisco back then, you would literally be in the red today. Yes, buying you a big tech stock will lose you money after holding for 2.5 decades. Who's to say that people buying Nvidia now won't suffer the same fate? You can never guarantee that one stock will survive the test of time. So in order to spread your risk across, you buy multiple stocks and diversify. Get used to that word since you're going to be hearing it a lot in this video. Let's say I buy Apple, Microsoft, Amazon, Google, Meta, and Tesla. I now spread my risk across 7 different companies rather than just one. So if something stupid happens that takes down Nvidia specifically, it only affects 1/7 of my portfolio. This is essentially what an index is. An index tracks the collective performance of a collection of stocks. The most famous index is the SP 500, which is the market cap weighted average of the 500 biggest stocks in America. So let's say one of the companies does horrible and falls out of the 500 biggest stocks, the SP kicks it out. It's not part of the index anymore. So you're only getting the 500 most successful companies at any time. Obviously that's a good thing. I'll explain what market cap weighted means later. Trust me, it's important. Hypothetically, let's say I have $100,000. That's how you know it's hypothetical. If I put that $100,000 into the SP 500, that money is split between those 500 stocks. I invested a little bit into each of them. Now, you can't just directly invest into an index. Instead, there are funds that track the index and you have to buy those funds. For the SP 500, the most famous fund is the ticker symbol SPY, which is owned by Spider, although there are many others. There are different types of funds, the most notable of them being ETFs versus mutual funds, which I'll cover in section 4.2. In exchange for the service they're providing me, I have to pay a small fee to Spider. For SPY, the expense ratio is 0.09%, meaning that for each $10,000 I invest, Spider takes away $9 each year as commission. But some other SP 500 ETFs, like VOO, owned by Vanguard, only have an expense ratio of 0.03%. While a 0.06% difference doesn't sound like much, trust me, it can literally cost you hundreds of thousands of dollars over time, as we'll see later. The appeal of index funds are the fact that you can just buy it and forget about it. You don't need to be checking your portfolio every second because you can have faith that the index on average will grow, compounding into millions of dollars over time. Obviously, it's not risk-free, but over the long term, it is nearly guaranteed to win. Okay, so you could technically just click off the video here. You could buy SPY, stay sly, never lie, let your gains fly, diversify, amplify, and watch your wealth multiply until you die. And yeah, that's what's so powerful about index funds. Even an absolute idiot could just press the buy button on some index funds and make money. But trust me, there are still so many things you need to know in order to maximize how much you can make and what is specifically the best portfolio for you. I know I already said this, but you should really stick around for the next hour or so. It could very well make you hundreds of thousands of dollars richer over the rest of your life. You probably have a bunch of questions right now. What indexes specifically should I invest in? How often should I continue buying into them? Why should I do this instead of researching the markets and trading? I'll answer all these questions and more. I know right now you want me to just tell you what index funds to buy to get rich, but you need these building blocks first or you'll be gambling blind. I just have one request real quick. Here's the deal. I will give you the rest of the blueprint with the exact tickers, exact strategies, and the tax loopholes for free. The only thing I ask in return is that you like the video and subscribe to Omni Capital. As a tiny finance creator, it's the best possible signal that tells the YouTube algorithm to make this video go viral. I've poured hundreds of hours into this video, and so if you've learned something or laughed at one of my stupid jokes, your support means the world to me. Thank you. Now let's get into the rest of the video. It's going to be a wild ride. Before we get into the actual logistics of creating and growing your portfolio, we need to understand the most basic question: what exactly are we buying? Most people just buy the SP 500 and think they own the market. It's a good start, but it's technically wrong. You only own one tiny slice in the market. To actually build a robust portfolio, you need to understand what's actually happening under the hood. In finance, we call these underlying characteristics factors. Think of stocks like food. You don't just eat food. You eat protein, carbohydrates, and fats. Each of them serve their own purpose in your diet, and you need a balance of all three in order to be healthy. Factors are these nutrients. These are the specific traits that actually drive where the stock returns come from. To be clear, we're not stock picking, because that's gambling, and I'm assuming you're above that if you're watching this video. Instead, we're ensuring that we have every single nutrient the market offers so we don't starve. So let's look at the menu. First, and the most simple, we have size, because size matters. The way we measure a company's size is through a metric called market capitalization, or just market cap. It's determined by finding the total value of all the shares of the company. For example, at the time of scripting, Nvidia is at 181.46. There are 24.3 billion shares in Nvidia, so the total market cap is found by multiplying those two numbers, giving us 4.41 trillion. There are 5 size classifications based on market cap, being micro, small, mid, large, and mega cap stocks. You usually only see index funds tracking small, mid, and large, with mega cap sometimes being lumped in with large cap, and micro sometimes being lumped in with small cap. No cap. Think of them like RPG classes. Large caps are the big, heavy tanks with high HP bars so they're hard to kill, but they move very slowly. Meanwhile, small caps are glass cannons. They are fast and volatile, but could have insane potential. They could 10x in a year, or get one shot by a recession. Like with any of the factors, it's good to be diversified across all sizes. This is probably a good time to talk about what market cap weighted means. As aforementioned, the SP 500 is market cap weighted. I said earlier that I split my money between those 500 biggest companies. However, it is not an even split. More money is going to the bigger companies. For example, at the time of scripting, Nvidia represents an entire 7.2% of the SP 500. You'd expect Nvidia to be 0.2% if it was evenly weighted, but since the S&P is market cap weighted, you're much more exposed to the trillion-dollar big tech stocks at the top. An equal weighted SP 500 does actually exist, ticker symbol RSP, where all the companies actually do only contribute 0.2% to the average, regardless of market cap. But investing in RSP is actually quite inefficient, since there's a more elegant solution I'll go over later if you want to limit your exposure to the biggest companies, which I will talk about in session 6. Okay, so now let's talk about geography. If you're someone who thinks US stocks are cooked, you'll probably want to buy stocks from other countries as well. Or maybe you're not even from the US at all, and your default option is your own country. This is known as home country bias. It's like playing Minecraft but never leaving the spawn chunk. You know where everything is and will stay safe, but you are limiting your true potential. You'll never be able to find a stronghold and beat the game. For the rest of this video, I'll mainly be talking from an American perspective, but I'll be sure to mention things from an international point of view as well. There's over 190 countries in the world depending on who you ask, but they're mostly lumped into 2 categories outside the US, emerging and developed. Developed countries are also known as EAFE, Europe, Australasia, and the Far East. I don't know why it's called Australasia, but essentially just means Australia and New Zealand. The Far East is basically just Japan, and Europe is only the west half of it. It's all the countries that aligned with the US during the Cold War, minus Greece and Turkey because screw them. Meanwhile, emerging markets are those that haven't been fully industrialized for centuries like the developed ones. The most notable countries include China, India, Brazil, and Indonesia. Russia used to be a big player as well, but their stocks were mostly removed from indexes in 2022. It's very rare that people invest in single specific countries outside their home countries, and instead they just buy ETFs to track emerging or developed markets as a whole. Now, let's say you don't think America is cooked. It will continue to prosper and outperform the rest of the world, like it has been for the last century. Should I still choose to invest in international stocks? And so, how much of my portfolio should I actually be allocating to them? I'll go into this more in depth when I talk about diversification and portfolio allocation later, but yes, you should always be investing in them. Maybe you could allocate a bit less if you think the US will outperform, but your opinion is as good as anyone else's. The same way you can decrease your risk by investing in multiple companies, you can decrease your risk even further by investing in multiple countries. Now that you understand how geography and size work, the third major factor is whether a stock is classified as growth or value. Growth stocks are companies that investors expect to grow their earnings faster than average. They're the ones dominating headlines, usually in tech. Think Nvidia, Tesla, Amazon, Meta. But it could also include smaller companies that are going all in on growth. These companies often don't pay dividends because they'd rather reinvest every single dollar back into expansion. The stock price tends to be high relative to their earnings because everyone's betting on their future potential. So when you buy a growth company, you're not buying it because it's cheap. You're buying it because you believe it'll be worth a lot more later. It's like buying a mansion blueprint instead of an old rental property. It's not necessarily valuable yet, but it could be huge if everything goes right. On the other side, you have value stocks. Companies that are trading for less than what they're actually worth based on fundamentals like earnings, dividends, or book value. Think Johnson & Johnson, Coca-Cola, or banks. These aren't the boring companies trying to triple every year. They're just solid, steady businesses that make money, pay dividends, and often get ignored because they're not shiny anymore. Value investing is its own rabbit hole, but the main appeal of value stocks is the fact that the true value is often more than the current price given by the market, and so when price and value eventually converge, they'll make a profit. There are technically other factors besides these three that people sometimes use, but they're not nearly as mainstream or significant. They include stuff like momentum, which filters by stocks which have already gone up a lot recently, and quality, which focuses specifically on companies with stable earnings and low debt. Again, it's not common to be buying index funds based on these. You can also classify stocks by the sector in which they operate in, such as energy or healthcare or whatever. But there's no real way to consistently predict which sector will do the best, so it's best to just buy stocks across all sectors with these indexes that hold everything, such as the S&P 500. It's good to know what the obscure factors are anyway, since they might come up at some point. Okay, so like I said, we should try to be diversified across all of these factors. The past decade or so has been incredibly favorable towards US mega-cap growth stocks, but it doesn't mean it'll stay that way forever. For instance, solely staying in the US would have absolutely cooked you in the 2000s. If you invested in the Nasdaq in 2000, which is another popular US large-cap index, you would literally be down 50% after a decade. We're not talking about a meme stock, we're talking about a goddamn index fund after 10 years. This happened because the US suffered two major crashes in the 2000s. To avoid scenarios like this, you need to be diversified. I will go into further detail about how to do this later on, because there's some important things you need to understand first. It's not a one-size-fits-all approach, and I'll show you how to create the perfect portfolio for your needs. And keep in mind that these three factors are almost always combined with each other. For instance, the S&P 500 is US, large cap, and has both growth and value. In particular, small cap values received a lot of attention for potentially being the most profitable factor combination, while small cap growth is a black hole of investing, whatever that means. My soul's escaping through this black hole that is gaping. I'm trading small cap growth when my confidence is tapering. These charts are always faking, every breakout ends up flaking. I'm waiting on a moonshot, but the downside's always waiting. And yeah, there are more asset classes besides stocks themselves in the first place. Gold and bonds are the two most common ones that are commonly tracked by index funds, but there's also other stuff like high yield savings accounts, money market accounts, and certificates of deposits, which are often shorted to CDs, nuts. Just real quick, let's talk about bonds. Governments and companies need money and are desperate for money, so they offer bonds where you give them money, and in exchange, they'll pay you back in full on the maturity date, as well as pay you a fixed interest rate so it's profitable for you. So why the hell would you do this? The S&P 500 is supposed to make you like 8 to 10% a year, but bonds only pay you like 4 to 5% at the very most. It seems like a total no-brainer to just go 100% stocks and call it a day. The simple answer for now is that bonds are supposed to be boring. They're your insurance when stocks crash, which they will. They're the slow and steady tortoise. A lot of people will invest in bonds through index funds that track them, and obviously you'll get the interest payments through dividends, but the price of the bonds themselves usually move in the opposite direction of interest rates. If interest rates go up, and you can buy bonds to pay you back more, there's less demand for your old bonds, and so people are willing to pay less for your old bonds since they have a lower interest rate. There are also multiple types of bonds. Bonds that mature very soon, like a couple months or a couple years, have almost no risk, since there isn't much that can go wrong that would interfere with the government's ability to pay it back in that short of a time frame. Meanwhile, longer-term bonds, like ones that expire in a couple decades, carry more risk, and so the issuer must offer a higher interest rate. unless the yield curve is inverted, which is its own can of worms. There are also corporate bonds, international bonds, whatever, but essentially, the main point of bonds are just to act as insurance, so you're not completely screwed if stocks crash. If you don't want to take on too much risk, some portion of your portfolio should be in bonds instead of stocks. We will go over this in incredible detail in section 6, where I talk about the 7-step algorithm needed to construct the perfect portfolio for you. Stick around for that. If you've watched any finance TikToks or Instagram Reels, you've seen the passive income gurus. They tell you to buy high-yield dividend stocks, sit on the beach, and collect free money checks forever. It sounds perfect, but it is a lie. Blindly chasing dividends is the fastest way to underperform the market and pay more taxes than you need to. I'm going to deconstruct the biggest myth in finance and prove to you why dividends are not free money. This doesn't necessarily mean that they're a bad thing, but you must exercise some caution. Dividend ETFs are quite popular, but you might want to stay away. Let's see if I can explain this in the next 5 minutes. Timer starts now. When companies make profit, they sometimes distribute a small portion of it to our shareholders. This can incentivize people to invest in it when they wouldn't otherwise. This is usually paid every quarter, but sometimes every month if you're lucky. The ex-dividend date is set a couple days before the day it's actually paid. If you buy the stock before the ex-dividend date, you will receive their next dividend. Let's say I buy $100 of a stock. If that stock has a yield of 4%, that means I make $4 from dividends per year. Since dividends are usually paid quarterly, that means I get $1 every 3 months. Usually, a yield above 4% is considered high, while something higher than 6 or 7% means that the company specifically wants to highlight their dividend and knows that investors will care a lot about it. However, this is not exactly real. It's all an illusion. Just like my relationship, when my wife left me and took the kids. Anyway, the yield might not actually be the most accurate representation of your dividends. Consider that example from earlier where I bought $100 of a stock with 4% yield. If that stock pumped 200%, that 4% yield means I'm getting $8 a year, not $4. However, I only bought $100 worth of stock in the first place. Therefore, my yield on cost is 8 divided by 100, which is 8%. I'm getting $8 of dividends from my $100 investment. All that sounds great, but here's the kicker. I'll explain this further in section 9, but the market is efficient. If everyone knows that the stock is about to pay a $5 dividend, they are willing to pay $5 more for it, meaning the share price is worth $5 more. Once the ex-dividend date passes and you no longer get the dividend by buying it, that share price drops by $5 since people aren't willing to pay that extra sum anymore. Another way you can think of it is that cash is physically leaving the company when they pay the dividend, meaning that they have less assets, meaning the company is worth less. This essentially means that if you have a $100 dividend, you get $100 paid to you, but the actual value of your shares also decreased by $100, meaning that you make nothing overall. So if that's the case, why do people care about dividends at all? Psychologically, people like the feeling of receiving steady income, even if selling shares would mathematically be the same. In addition, a company that has a dividend shows that they at least have some level of financial stability. And dividends are often taxed differently from capital gains, so it allows you to turn unrealized profit into realized profit with a lower fee than if you're intending on selling some shares anyway, but it does depend. DRIP stands for Dividend Reinvestment Plan. This means that you automatically put the dividends you get into buying more shares of the stock. This allows you to buy shares at the lower price and do so the ex-dividend date, which can add up and compound over the long term. Unless you specifically want to use these dividends for actual income that you're using for your real life expenses, I would highly recommend doing this. Pretty much every brokerage offers it. I could make a joke about the word drip, but I'm too tired to come up with one right now. It's like 2 AM right now as I'm scripting this. Please send help. Like I mentioned, having dividends psychologically feels great, and it is easy to fall into the trap of blindly prioritizing them. I certainly did myself a couple years ago. However, especially if you're not planning on actually taking out these dividends as cash, you really shouldn't care. Even if you drip them, due to all the transaction costs and slippage and whatnot, you actually have slightly less equity compared to if the company didn't pay the dividend at all. You can use dividend ETFs as a proxy for the value factor from earlier, since value companies often pay dividends, but at that point, why not actually buy a real value ETF? So yeah, invest in the ETFs you would otherwise and turn on drip, and you should be fine. For 95% of people, you should not specifically go out of your way to buy ETFs with a high dividend. It will only slightly hurt you in the long run. I just want to ask you for a quick favor. If I've given you any value so far, please just take a second and click like and subscribe. I promise, if every single one of you who's watching at this point clicks those 2 buttons, this video will go viral. I want nothing more than to see OmniCapital succeed. Again, if every single one of you just do this, it'll help me out infinitely. YouTube's algorithm has been cruel to me, but let's fight back as a community. I'm confident that this will be the video that'll make OmniCapital go viral, so let's make it happen. Thank you so much. I'll give you 10 seconds to go do it real quick. You now have a lot of the basics. We've discussed a lot of things so far, but it gets more complicated. Unfortunately, the financial industry is designed to confuse you. There are still other things you must consider to make sure you actually know what you're doing. If you go to your brokerage app and search up S&P 500, you're going to see like 50 different options. Which one should you buy? What are some other considerations you must keep in mind when picking ETFs? Like I said before, you could just click off the video and press the buy button on some index funds to still make money. But why not stick around for longer to make even more money in your life? I promise, I will put it all together and tell you exactly what to do to construct the perfect portfolio for you in like 6 or 7 minutes, but there is some other stuff you must know first. This entire time I've been saying index funds, but it's actually kind of vague. There are 3 types of financial products that track indexes, and you need to know the difference. ETFs, or exchange-traded funds, are products that trade like normal stocks. Companies like BlackRock and Vanguard list these products that track the indexes, and you can buy it like a normal stock. Their price can vary due to the supply and demand of the ETF itself rather than the index, although this variance is usually negligible. These are solid options with no real drawbacks. Mutual funds are the more traditional option and have been around longer than ETFs. They only trade once per day, meaning that they aren't subject to the fluctuations that supply and demand bring. Their ticker symbols are 5 letters ending in the letter X. Honestly, just forget them. Almost every mutual fund is an ETF equivalent nowadays, and there's literally no reason to specifically choose them since they also have higher fees and front-load costs. There's also a trap where you can get hit with taxes even if you never sell them. Some brokerages like Robinhood don't even let you buy them. Screw mutual funds. All my homies hate mutual funds. Meanwhile, ETNs are so god-awful that I only put them in this video to specifically tell you not to invest in them. ETN stands for Exchange Traded Note, which already just sounds worse than a trade-traded fund. Remember, all the way back in section 1, when I told you that when you buy the S&P 500, you split your money across 500 stocks and you own a tiny piece of each one of them? Well, with an ETN, you own nothing. All you have is a piece of unsecured debt from a bank promising you that they'll pay you the return of the index. So if the bank that issued you the ETN goes bankrupt, which does happen, your investment goes to zero. Poof. Gone. If you've heard of Lehman Brothers during the 2008 recession, you know what I'm talking about. You aren't an investor. You're just another guy the bank owes money to, and you're just another guy who will get screwed over by their nonsense. Don't get cooked. Stay the hell away from ETNs. So for the rest of this video, when I say index fund, I'm only referring to ETFs since they're the only real option. It's probably better than the other options you're investing in. Haha. This is very simple. A passively managed fund means that it's only tracking a set index and there is no human intervention. An actively managed fund means that a manager is actively trying to pick stocks or change allocations to try and maximize returns. Passive funds obviously have lower fees than active ones. Section 9 will touch more about this, but even the expertise of fund managers doesn't mean they will always outperform a passive index. You're almost always better off just investing in the passive ETFs. A passive ETF should perfectly copy the index it's tracking. However, it will often fail at its one job. If the S&P 500 index goes up 10% in a year, you'd expect your S&P 500 ETF to also go up 10%, right? Wrong. it'll go up like 9.94%. That 0.06% gap is the tracking error. So why the hell does this happen? There are two main reasons. Firstly, the ETF has fees, so you are guaranteed to underperform the index by a tiny bit. And secondly, cash drag. The manager of the fund isn't 100% invested in the index. They have to keep a tiny bit of cash to provide liquidity to the people buying or selling the ETF. That tiny sum of cash isn't growing with the market, so you will slightly underperform the market. Funnily enough, this means that you will lose a bit less when the market crashes. There are other reasons for tracking error as well, but that should give you a decent idea. You don't need to lose sleep over tracking error since most of the time it's negligible. But if you ever see some weird obscure ETF and its tracking error is higher than my IQ, it means that the fund is trash and the managers are incompetent. Just stick to the major low-fee funds and you'll be alright. Since the whole point of index funds is the fact that you buy and hold them, liquidity isn't too much of a worry. However, it can still be important for other reasons. In case you don't know, liquidity is how easy it is to enter or exit a position at the price you want to at the speed you want to. For instance, something like a house is incredibly low liquidity because it could literally take years to get it sold, and you'll likely sell it for a price lower than your ask price after negotiating. Meanwhile, something like a mega cap stock, which sees millions of people trading it every day, has a high liquidity, since you're literally just pressing the sell button on your phone and you're all set. Since you're not going to be constantly buying or selling the index fund, it's not that big of a deal, but it's still good to still know it. For ETFs, liquidity is generally correlated with a measure known as assets under management, or AUM. This is just how much money is invested in the ETF. If I invest $100 in SPY's total AUM goes up by $100. If Wojak invests $350 into SPY's total AUM goes up by $350. A higher AUM means that more investors trust the ETF and more people are buying it. You could also look at the volume to see how many shares are being traded each day. Stay away from ETFs with very low AUMs. $50 million or lower is the danger zone. The ETF could be shut down if no one's investing in it, so you want to make sure that won't happen. These fund providers like Vanguard and BlackRock aren't providing these ETFs out of the goodness of their own heart. You really think BlackRock would do that? No. In exchange for the service they provide by managing the ETF, you must pay them a fee. Now, if the ETF is passively managed, the expense ratio is usually incredibly low, like 0.06 or 0.07%. An actively managed fund or any other special type of fund, like a leveraged or covered called ETF, will have significantly higher expense ratios. As we will see in section 6, you will often find more than one ETF that tracks the same index. In that case, always pick the one with the lower expense ratio. Even if it's a tiny difference, it can actually have a significant impact because of the nature of compound growth. For instance, let's say we invest $100,000 into two identical ETFs that track an index that go up 8% a year, but one of them has an expense ratio of 0.2%, while the other has a ratio of 0.1%. After 50 years, the one with the lower expense ratio will literally be up more than $200,000 than the other one. That's a Ferrari. You may as well just pick the ETF with the lower expense ratio. It can only ever help you over the long term. Now we enter the danger zone. There's a reason I gave leverage its own section, even though it's technically just another nuance. It appeals to a lot of people willing to take on more risk in exchange for a greater payout. Some people say leverage is the 8th deadly sin, but others say it's a one-way ticket to the moon. Both of them are wrong. Leverage is a flamethrower. You can use it to clear a path through a jungle and build wealth 10 times quicker. Or you can point it the wrong way and burn your entire house down. With some 4th grade math, we can figure out exactly how this thing works. The simplest definition of leverage is magnifying both your gains and your losses. Let's take the S&P 500 and apply 2x leverage to it. If the S&P goes up 1%, we go up 2%. If the S&P goes down 5%, we go down 10%. That's literally it. You multiply your gains and your losses, so obviously you're taking on more risk by doing this. But trust me, as we'll see in a couple minutes, the simplicity is misleading. Unfortunately, this is not exactly how it works, and its misunderstanding costs people millions of dollars. One of the most common ways people achieve leverage is by taking out margin. I have $1,000 and borrow another 1,000. I use that $2,000 total and buy a stock, and it goes up 10%, so a profit of $200. I then pay back the $1,000 I borrowed. That means I made $200 off a $1,000 investment, even though the stock only went up 10%, so that's 2x leverage. Obviously, if a stock went down 10%, you would lose $200, so it does go both ways. Like any loan, you need to pay interest when you take on margin, so it isn't the most ideal. And obviously, if you lose everything, you're now in debt. In addition, you run the risk of getting margin called if the index fund drops a huge amount, meaning that you must add more cash in to stay above your maintenance account, or your broker will forcibly sell your shares. Yikes. A newer alternative that many people like are leveraged ETFs, but they have their own set of drawbacks, unfortunately. I want to get 2x leverage on QQQ. Luckily for me, there's an ETF named QLD that offers 2x leverage for me. I can just buy it like a normal ETF, and the return of that ETF is twice the return of the underlying. These ETFs are incredibly popular, and I even made 2 videos about them. Please don't watch them. My videos absolutely sucked 2 years ago when I made them. Do not subscribe because trust me, you don't want to see them. These ETFs have very high expense ratios as well as an extra 1% borrowing cost. If you're willing to pay that for the extra leverage you get, then all the power to you. A lot of people swear by investing in them for the long term. After all, stocks usually go up over the long term, and if you leverage that, you'll just be up even more. However, this is incredibly dangerous. That notion is actually wrong. Let me explain why real quick. You'll be hearing a lot of random numbers and percentages, so pay attention. I hope section 5.5 helps at least one person thinking about leverage and shows them how it truly works, perhaps saving them hundreds of thousands of dollars, just like I said in the very beginning of this video. Now, this thing I've been hyping up over the last 30 seconds is known as volatility decay. Take a shot every time I say volatility decay in this section. It actually pisses me off. 90% of people online completely misunderstand what volatility decay means and are just spreading around misinformation. It's gotten to the point where if you search it up, you'll probably be more confused than where you started. Lucky for you, Omni Capital is here to save the day. If you listen to what I have to say and stay while I play Minecraft on the screen, you can get paid and lay down the money in May because of volatility decay. Decay sounds scary, but volatility decay isn't necessarily a bad thing. It will both hurt and help you. It is basically just derived from the fundamental nature of how multiplication works. If you want to avoid volatility decay, you literally have to hop into a wormhole and travel to another universe where the laws of math are different. To be completely clear, volatility decay affects any investment that goes up and down, but the problem is made much worse when using leverage. Stick with me here. So you know how the market goes up around 8% a year, right? However, it doesn't just continuously go up 8% a year. There's lots of variation, whether on a scale of decades, months, or minutes. Stocks constantly go up and down, but they end up averaging out to 8% a year. And all that variation hurts leverage. Let's say the market goes up 20%, then down 20%. The total return is 1.2 times 0.8, which is 0.96, or 4% down. Notice that even though we went up and down the same percentage amount, we ended up down overall. This is just how multiplication works. For example, if you go down 80%, you need to go back up 400% to break even, not up 80%, because 0.2 times 5 is 1, not 0.2 times 1.8. This effect is made much worse because of leverage. In the same situation, where the index went up and down 20%, a 3x leverage ETF would go up 60% then down 60%, so 1.6 times 0.4, which is 0.64. The regular ETF was down 4%, but the 3x leverage ETF was down 36%. Again, this is just because of how multiplication works. Note that volatility decay does not affect margin in the same way. Margin is not path dependent. Just multiply the index's final return by how much you're leveraging by. In that example, the regular ETF is up and down 20%, so 4% down. You just multiply that 4% by 3, so your return is 12% like you would expect, rather than 36% with a leveraged ETF. However, leveraged ETFs, since the volatility resets daily, are very path dependent. If there's a lot of choppiness, decay will screw you over, and a crash will just wreck you, since it'll take very long to recover from the loss. For instance, the dot-com crash demolished a lot of the big tech stocks that comprise QQQ. If you bought QQQ at the end of 1999, you would not have broken even until 2016, which is already awful. but with TQQQ, the 3x leverage version, you would have lost 99.97% in the dot-com crash, which is just spectacular. Even now, in 2025, coming off a huge 16-year bull run, you would still be down, while regular QQQ is up hugely. That's how volatility decay can burn your entire life savings. Now, volatility decay isn't necessarily a bad thing. The whole point of this hour-long video is that stock returns compound over time, growing your money exponentially. During a bull market, leverage compounds your money even more. For example, during that insane bull run from 2010 to 2021, QQQ went up 829%, but TQQQ went up 19,000%. So yeah, volatility decay is something you must consider with leverage ETFs. Treat leverage like a knife. It can be very helpful when used correctly, but make sure you don't stab yourself. This is foreshadowing session 6 and 7, but whether you use the power of leverage depends on your preferences. If you're okay taking on much more risk and potentially being screwed over during a crash, then I would definitely go with leverage. Stocks usually go up, so most of the time, leverage will help you. Section 6.8 will actually talk about a specific strategy with leverage that keeps all the returns of it with almost none of the risk. Stick around for that. So let's say you decide to leverage. Should you use margin or leverage ETFs? Well, margin incurs huge fees, like upwards of 8%, while the cost of a leverage ETF is 2% at most. As aforementioned, leverage ETFs have volatility decay while margin doesn't, which can be a good or a bad thing. I personally like something like 1.5 or 2x leverage if you're willing to take risk and want to hold it for the long term. 3x is a bit too degenerate for me since you're completely wrecked if a crash happens. I also do prefer leverage ETFs over margin, but again, it is your choice. I gave you the facts, and now you make the decision. Wow. When I first started scripting section 5, I assumed it would be like 3 minutes long at most, but it ended up becoming a beast. But now, finally, your patience has paid off. The next 2 sections will put it all together. We will learn how to construct the perfect portfolio for you in section 6, and the actual logistics of long-term investing in section 7. These are the 2 most important sections of the video, so pay attention. Feel free to rewind a couple minutes if you didn't quite grasp it, since there's a lot we're about to cover. I've been yapping like a lunatic for 40 minutes now, but now that you know the vocabulary, the math, and the pitfalls, it's time to build the actual machine that will make you millions. You remember how at the very end of section 1, I said that I couldn't tell you what index funds to buy? Well, that still stands. Everyone is different, and there is no one-size-fits-all solution. So let's start from the very foundation of how to construct a portfolio, and make sure we find the best possible one for you. Time to lock in. You might be a bit overwhelmed right now with all the information I'm throwing at you, so let's take a short break. Consider it as a checkpoint. Enjoy the Minecraft gameplay, and just relax. Now it's time for risk tolerance! Risk and reward are closely correlated. If you want higher returns, you have to accept higher risk. I'm assuming all of you know this already. So what's the happy medium for you? What's the perfect balance? Now here's the problem. You are lying to yourself. Almost everyone overestimates their tolerance, just like me on the couch last Friday night. It's very easy to say, oh, I have a high risk tolerance, when the line is green and you're making money. Everyone is a genius in a bull market. But your actual risk tolerance is only tested when the market is crashing and the world feels like it's ending. So let's run a simulation. Imagine you have $100,000 saved up. You've worked years for this money. And then, over the course of the next 2 months, the market gets cooked. Your account is now worth $70,000. 30% of your money is gone. Vanished. How do you react? Person A panics and sells everything to stop the bleeding. Person B shrugs, says sweet, stocks are on sale, and maybe buy some more. If you are person A, you have a low risk tolerance, and that's okay. But you can't have a portfolio that's 100% stocks. You need a lot of bonds as insurance, or you will panic sell at the bottom and destroy your wealth. It's probably worth revisiting section 2.8 so you truly understand how they work. But if you are person B, and you actually are person B, not just pretending, then congratulations. You can handle the volatility of a 100% stock portfolio, or even greater than 100% by using leverage. Be honest with yourself now, because once the crash starts, it's too late to change your mind. The bottom line is that you must be comfortable holding your portfolio no matter what. So many people overestimate the risk tolerance, and it's good to truly ask yourself if you'll be able to stomach a crash before moving on to the rest of section 6. So we know we need to take risk, but we don't want to go in blind. How do we know if a portfolio is actually good? We use a time machine. This is called backtesting. A backtest shows you how your portfolio would have performed in the past 10, 20, 30 years. It's pretty simple. You take the portfolio you want to build and run a simulation using real past market data. Tools for this are sites like Portfolio Visualizer and Testfolio. They're mostly free, but also quite powerful. You plug in your tickers and it spits out exactly how much money you would have made. But here's the warning. Backtesting is dangerous. It is addictive. And if you use it wrong, it will lose you money. The biggest trap in investing is looking at a backtest of the last 10 years, seeing that US mega-cap tech stocks went to the moon, and thinking that outperformance will just continue forever. Past performance does not predict future returns. That's called recency bias. It's the equivalent of driving while looking at the rearview mirror. Just because something worked in the past does not mean it'll work in the future. If you ran a backtest in 2009, it would have told you that US stocks are trash and you should buy emerging markets. But if you did that, you got cooked for the next decade. So why do we backtest if the future is unpredictable? Is there any point? We don't do it to predict returns. We do it to predict risk. Use the backtest to look at the max drawdown. Look at something like 2008 or 2022. Did the portfolio drop 90%? Or did it hold its own? That's the real value of a backtest. It shows you the worst case scenario. If you look at that line on the chart and would vomit if it happened to you, then it's probably not the best portfolio for you. Also, pay attention to the start date. If you start your backtest in 2009, which is the bottom of a crash, everything looks like a rocket ship. If you start in 2000, at the top of a bubble, everything looks depressing. Don't cherry pick your days to make yourself feel better. Just like anything to do with statistics, backtests can be misleading, so make sure you're always getting the full picture. We're going to talk about CAGR, standard deviation, Sharpe, and beta. These 4 scary sounding terms are basically statistical measures that help us better understand a backtest. They're the portfolio's report card. Let's just rapid fire them. CAGR stands for compound annual growth rate. This is the big one. This is the actual return. So why not use the average return? Well, because of volatility decay, average return can be quite misleading. Let's say the first year go up 100%, then you go down 50% the second year. Since 2 times 0.5 is 1, you're break even, but the arithmetic mean of 100 and negative 50 is plus 25, which is misleading. Instead, we use a geometric mean. The way you calculate this is a bit scary, so look on screen if you aren't already. The formula for it is the ending value divided by the beginning value to the power of 1 over the number of years minus 1. In that earlier example, your ending value dividing by your beginning value is 1, and 1 to the power of anything minus 1 is just 0, which makes sense because you're break even. Let's take another example. If my portfolio doubled in 10 years, my CAGR is 2 to the power of 1/10 minus 1, which is around 7.1%. You will probably never have to actually calculate CAGR in real life since any backtesting app will show it for you, but I just want you to know what exactly it means. Nominal CAGR is how much the pure return is, while real CAGR adjusts for inflation. Now, standard deviation is just another term for volatility. Obviously, almost every asset will go up over the long term, but how much variance was there on the way up? A higher standard deviation means that there are more fluctuations, while a lower standard deviation means the asset's more stable. If 2 portfolios have the same CAGR, but one has a lower standard deviation, choose the lower one every time. Why take on more stress for the same amount of money? Sharpe is a measure that shows you risk-adjusted return. This is a metric that everyone should seek to optimize. The calculation is the portfolio's return minus the risk-free return divided by the risk, so basically expected value per unit of risk. What the flip is the risk-free return? Well, remember how I said back in section 2.8 that short-term bonds basically carry no risk? However, they can still make you money despite being risk-free. The interest rate of these ultra short-term bonds are used for this. If you can make guaranteed money by investing in these short-term bonds, you need to be paid more relative to that to justify the extra volatility you're taking on relative to the risk-free investment. A Sharpe ratio above 1 means that it's probably a decent investment, and obviously more is better. Beta tracks how volatile the portfolio is relative to the market itself. Most people use the SP 500 as a proxy for the quote-unquote market. For instance, let's say you only invest in VOO, an ETF that directly tracks the SP 500. What would you expect your beta to be? You're kinda cooked if you can't figure this out. Well, it's 1. It's the exact same. You move exactly with the market. Meanwhile, something riskier like the Nasdaq will have a beta greater than 1, since it has bigger swings than the S&P. Something like bonds has a beta less than 1. A beta of 0 means it has no correlation with the stock market, and a negative beta means it goes down when stocks go up, and vice versa. You might think that we want negative beta assets in our portfolio to diversify, but no. Since stocks usually go up, these inverse assets usually go down, which is not what you want. For instance, SQQQ, a negative 3x leveraged ETF of the Nasdaq, is down literally 100% over the last 15 years. It registers as 100%. So I know I just spewed a bunch of information at you, but the bottom line is that you shouldn't just look at how much money your portfolio made. Anyone can go to the casino and make insane returns. You also need to be paying attention to metrics like Sharpe. The goal is to get high returns without taking on insane risk. Section 9.6 will take this idea to a whole nother level, but let's go through everything else first. Risk parity is a specific strategy that involves making sure that each asset you're investing in contributes the same amount of risk to the overall portfolio. Theoretically, this will help maximize your Sharpe, your risk-adjusted return, which is obviously a good thing. Stocks are significantly more volatile than bonds. In a 50-50 portfolio, stocks are actually responsible for about 90% of the risk. Think of it like a group project in high school. You have one kid doing 90% of the work, that's the stock market. And you have the other kid just sitting there eating glue, that's the bond market. If the stock kid is sick one day, the entire project fails. The bond kid isn't doing enough to save you. Risk parity fixes this. Instead of balancing the money, we balance the risk. Since bonds are less volatile, we need to own way more of them to match the volatility of stocks. We're talking like 20% stocks and 80% bonds. Now, both assets are contributing equal amounts of danger to the portfolio. It smooths out your ride and mathematically gives you the highest Sharpe ratio possible. Now you might be asking yourself, if the risk parity portfolio is 80% bonds, isn't that going to lead to a much lower actual return even if the Sharpe is technically higher? I have a high risk tolerance, so I want high returns. Well, wait a couple minutes because there's a brilliant solution to this which I'll cover. People like Ray Dalio have made their entire career off the concept of risk parity, and many hedge funds use it because it optimizes your portfolio mathematically. Section 6.7, 6.8, and 6.9 will tell you the actual process of putting the portfolio together. These are literally the last couple of minutes before you will actually know the portfolio you'll be investing in for decades. So let's not mess this up. Let's get all the nonsense out of the way now. Do you have any other preferences with your portfolio? If so, you probably shouldn't. Here's 3 common examples. Many younger investors care a lot about supporting ethical companies. In finance, these are known as ESG, which stands for environmental, social, and governance. The pitch sounds great. Don't invest in evil companies destroying the planet, invest in the good guys. But here's the reality check. ESG is often just a marketing label used to charge you higher fees for the same stocks. If you look at the top holdings of an ESG fund, do you know what you'll see? Apple, Microsoft, Amazon, Nvidia. It is literally the same list as the regular index, but they charge you 3 or 4 times the expense ratio just to slap the ESG sticker on it. It's called greenwashing. The only difference is that these indexes remove a couple small tobacco companies or whatever. They are 99% the same. If you look at a backtest of an ESG ETF and the SP 500, they are identical. You are likely just flushing money down the toilet to feel better about yourself while owning the same companies. Second, the smart investor thinks he's better than everyone else. This is the guy who wants to tilt towards specific sectors or countries. Bro, AI is the future, I'm going all into tech. Or, India's next superpower, I'm going all in on the India ETF. Listen to me. Both of those things could be true, but you still shouldn't do this. You are not smarter than the market. By concentrating on one sector, you are undiversifying yourself and unraveling the whole point of this video. You are taking on what we call idiosyncratic risk without any actual guarantee of higher returns. If the tech sector gets cooked, like it did in 2000, your portfolio evaporates. Remember, if you diversify properly, you already own all the tech companies and all the Indian companies. You own them in the correct proportion the market decided they are worth. Don't try to be a hero. You can never outsmart the market. Just buy everything and you'll be fine. And finally, you might have a crippling gambling addiction like I do. I know you. You want to pick stocks. You want to buy some crypto or trade 0 DTE options because you saw it on TikTok. If I tell you don't do it, you're gonna do it anyway. So here's the deal. You can have a fund money account. This is physically a separate account. It is only limited to 5 to 10% of the funds you set aside for investing. Treat this money as already gone. This is the price of admission to satisfy your gambling addiction. If you 10x it, great. If it goes to 0, it won't ruin your life because the remaining 90% is still compounding in the background. But never mix the two. Alright, that's the last warning. Now let's build the actual portfolio. 6.7, 6.8, and 6.9 are probably the 3 most important subsections of the entire video. They will be long and complicated, but trust me, it'll pay off. This is what you watched all this way for. I swear to God I didn't plan to have the climax of the video start at section 6.7, but I guess fate has spoken. Well, it's time. I'm finally gonna tell you which specific indexes and ETFs you need to buy. Let's see what we're working with first. Do you remember section 2, when I talked about all the different factors? Let's just refresh all of them real quick. We want to diversify across size, which is large, mid, and small caps, geography, which is the US, developing and emerging markets, and growth versus value. And then obviously there's bonds for people with lower risk tolerances, which have varying maturity dates, treasury versus corporate issuers, and once again, geography. That's a lot to diversify across. That's no less than 36 factor combinations we need to cover. Will we need to buy 36 ETFs? That seems like a nightmare to manage. Well, no. As aforementioned, an index obviously covers more than one factor combination. A simple example is the SP 500, which covers 2, being US large cap growth and US large cap value. And we don't necessarily need to cover everything. For instance, most investors buy a large cap and small cap ETF, but skip mid caps, there's no real point. Now, let me blow your mind. Remember a minute ago when I roasted the guy who wanted to go all in on tech stocks in India? Well, that was because he was taking on idiosyncratic risk. Think of it as a specific risk. It's the risk that something goes wrong with just one specific company or sector, like a CEO getting arrested or a new regulation that bans AI. Here's the problem. The market pays you absolutely nothing for taking this risk. Why? Because it's free to fix. You can eliminate it entirely just by diversifying. Since it's so easy to avoid, the market doesn't reward you for accepting it. You are taking on more stress without the mathematical expectation of a higher return. But factors, like cap size or value, that's systematic risk. I originally wrote my own explanation of how it works, but it ended up making no sense, so I asked ChatGPT to explain it simply. So enjoy what it has to say. I promise you, 90% of the finance videos you watch on YouTube are completely AI generated, so I decided to include to be more like them. But wait, why does systematic risk actually pay you? Think of it like a job site. If you decide to juggle chainsaws during a lunch break, that is idiosyncratic risk. You are taking on extra danger, but your boss isn't going to pay you extra for it. He's just going to call you an idiot. You could have just not juggled the chainsaws. So the risk premium for that is 0. But factors are different careers in dangerous industries. It's like working in an oil rig when there's a hurricane coming. It is fundamentally more dangerous. Because you risk getting hurt, you demand a higher salary. That's the risk premium. Let's take something like small cap value, which is an incredibly popular factor combination. Small, cheap companies are fragile. In a recession, they're the first to die. You can't diversify that risk away because all of them are fragile. Because the job is terrifying and uncomfortable, the market must offer you a higher salary to convince anyone to do it. That is why factors work. You aren't getting paid for being smart. You're being paid for accepting a more dangerous job description. Wait, that's actually kind of good. I probably should have just had ChatGPT generate this entire video rather than me spending 100 hours scripting it. If you're someone who appreciates the fact that I'm the one making this video, which for some reason isn't assumed nowadays, please give me a token of your appreciation by liking and subscribing. By the way, if you somehow still remember the equal weighted ETF named RSP that I mentioned an hour ago, this was the elegant solution I was talking about. Exposing yourself to small caps has the same effect as decreasing your exposure to the big tech stocks on the top, while saving fees since RSP is a high expense ratio. RSP is a great idea in principle, but diversification takes that concept and just makes it better. So I just thought I would put that in there. Everyone, including me 15 minutes ago, tells you to diversify, but that's exactly why you actually need to do it. We're still on subsection 6.7 by the way. I'm telling you, this one's a big one. The Yat Fest over. Now that I explained the rationale behind the different ETFs you're going to buy, here are the actual names of the potential ETFs. There are a ton of ETFs for every situation, but I'm going to tell you the ones with the lowest expense ratios and the highest AUMs, if you remember what those are from section 4. By the way, blend means both growth and value. International means everything outside the US, so both developed and emerging markets. A lot of these will be redundant and overlap. For example, I'll talk about both the US total market and US small cap value, even though small cap value is technically covered in the total market as a smaller portion. Listing every single ETF here would take absolutely forever, so I linked a PDF in the description that has every possible one you would want. I'll mention the most notable ones here though. Remember, each one of these factors has multiple ETFs you could buy that track them, but I'm only going to name the one I believe is the best. VT covers absolutely everything. VTI is the total US stock market, while VXUS is the total market outside the US. S&P 500, which is US large cap blend, while QQQM is the Nasdaq 100, which is US large cap growth. SEHD is a great large cap growth fund too that you might see in a lot of situations. AVUV is the best US small cap value ETF, while AVDV is the best international small cap value. Speaking of international, VEA is developed markets and VWO is emerging markets. BNDW is total world bonds, BND is total US bonds, and BNDX is total international bonds. BSV is US short-term bonds, while TLT is US long-term bonds. Obviously, there's a lot of factor combinations and even leverage ETFs I didn't mention, so check out the PDF for that after watching the rest of this video. So now we have our choice of assets. Which one should you pick, and what percentage should we allocate to each one? We're going to talk about that now. That's kind of a hard question to answer, but luckily other people have answered it for us. Let's take a look at some of the most famous portfolios and see what works for you. I'll cover 4 of them. I'm not saying you need to invest in these ones specifically, but it'll hopefully help demonstrate the rationale behind making a good portfolio. Or you could just copy one of these that you like, there's nothing wrong with that. Firstly, the Bogleheads 3 Fund. You might have noticed a lot of the ETFs I just mentioned started with a V. That's because Vanguard is a company that issues them, and the late John Bogle is a person who founded Vanguard. He preached the importance of passively investing in index funds, and now has a cult-like following, who are known as Bogleheads. The Bogleheads 3 Fund is the vanilla ice cream of investing. It's not the most flashy, but it's arguably the most reliable and simple way to build your wealth. Like the name suggests, it's 3 ETFs, 60% VTI for US stock market, 20% VXUS for international stock market, and 20% BND for bonds. You're buying the entire haystack. You own basically every investable company in the world. You're capturing pure market beta. You aren't making any bets on which country or sector will win. You are just betting that capitalism will continue to exist. You can spend exactly 5 minutes a year on your portfolio. You accept that you will never beat the market, but you sleep amazing at night knowing that you will never underperform the market either. Historically, this provides a solid, steady CAGR of 8%. The standard deviation is moderate to low since the bonds smooth out the ride. This portfolio right here is the benchmark. If your complex, leveraged, factor-tilted portfolio cannot beat this 30-fund strategy over 20 years, you wasted your time. The overall expense ratio is only around 0.04%, meaning that for every $10,000 invested, you pay literally $4, less than a Big Mac. Compare that to an actively managed fund where you might have to pay $100. Next up, we have the factor-tilt portfolio. This is often associated with Paul Merriman, who realized that while Bogleheads 3 Fund is great, it's a bit light on the dangerous stuff that actually makes the most money. You take that boring Bogleheads portfolio, but you tilt heavily towards small cap value. His original portfolio is slightly different from the one I'll say now, but this is a variation that's very commonly used. A setup is something like 50% VTI, 20% VXUS, 20% AVUV, and 10% AVDV. AVUV and AVDV are small cap value funds if you remember. We already learned that factors like small cap value carry systematic risk. By tilting your portfolio towards them, you are mathematically increasing a risk premium that the market pays you. This is for the person who wants to beat the market, but is willing to endure pain to do it. And trust me, there is pain. Just like the last 3 years, there will be time where large cap growth skyrockets and small cap value does nothing. You will feel stupid, you will want to sell. But if you hold for 20 to 30 years, that extra volatility historically compounds to massive outperformance. It has higher returns than the 3-fund portfolio, obviously, but it has higher volatility, obviously. It's slightly more expensive since AVUV and AVDV have higher expense ratios than the ultra low-cost Vanguard funds. But my entire rant a couple minutes ago about idiosyncratic versus systematic risk is what makes the Merriman Factor Tilt portfolio so powerful. Third on the list is the all-weather portfolio. This was popularized by Ray Dalio, the founder of Bridgewater, the world's largest hedge fund. His philosophy is simple. The economy has 4 seasons: inflation, deflation, rising growth, and falling growth. You don't know which season is coming next, so you must build a portfolio that can survive all of them. 30% US stocks, which is VTI, 40% long-term bonds, which is TLT, 15% intermediate-term bonds, which is VGIT, 7.5% gold, which is IAU, and 7.5% commodities, which is GSG. We didn't even talk about gold and commodities, but just know that their beta is close to zero, so they have very little correlation with stocks. Remember risk parity? This right here is a textbook example. Stocks are volatile, so Dalio only holds 30% of them. Bonds are stable, so he loads up on 55% of them to balance the risk. Gold and commodities are there for the inflation season, which kills both stocks and bonds. If looking at a red portfolio makes you physically ill, this is for you. In 2008, when the S&P 500 dropped nearly 40%, this portfolio was down 4%. This portfolio gives you a high Sharpe ratio, but lower actual returns. Since you only have 30% stocks, you will be left in the dust when the economy is booming, like the last 15 years. But you will be the only one chilling when the crash happens. This is the most expensive one so far. While the stock and bond parts are cheap as always, gold and commodity ETFs are pricey. We're paying a slight premium for the insurance against the apocalypse. Finally, we have the most exciting option. I absolutely love this portfolio. This is the brilliant solution to the risk parity problem I mentioned earlier. If using risk parity leads to low returns, how do we fix that? The solution is known as Hedge Fundy's Excellent Adventure, or HFEA for short. The components are 55% UPRO, which is 3x SP 500, and 45% TMF, which is 3x long-term treasuries. You're buying triple leverage on stocks and triple leverage on bonds. This relies on a concept called convexity. When the stock market crashes, the Federal Reserve usually slashes interest rates to save the economy. When rates drop, bond prices go up. And because of the 3x leverage on long-term bonds, they don't go up a little, they pump to the moon. Here's the part that sounds too good to be true. For almost all of history, obviously the strategy will have higher returns than the market, but it's actually safer than the market too. During the COVID crash of 2020, the S&P 500 dropped 34%, but HFEA only dropped 15%. Why? Because TMF shot up nearly 60% in a few weeks, canceling out the stock crash. It's the perfect insurance. You get 3x the returns of the market during the bull run, with less of a drawdown during the crash. It feels like a cheat code. But cheat codes all get patched. This entire strategy relies on negative correlation. If stocks go down, bonds go up. But in 2022, we had high inflation. The Fed raised rates which cooked bonds, while stocks crashed because of recession fears and global uncertainty. The inverse correlation broke. While the S&P 500 was down 18%, HFEA was down 65%. 2022 was literally the only time in the last 50 years where HFEA got wrecked, so if you do have a long time horizon, it is likely to outperform everything else, provided you understand that high inflation is your kryptonite. It also has an incredibly high expense ratio of the extra returns more than compensate for it. So yeah, adore the strategy. If you have a high risk tolerance, I highly recommend it. Still not a financial advisor, by the way. So now, let's take what you've learned from these model portfolios and figure out your own portfolio. Okay, deep breath. I just threw an insane amount of information at you. We have a menu of 30 different ETFs, 4 different philosophies, and weird concepts like convexity and idiosyncratic risk. Your brain is probably melting. You might be thinking, bro, I've been listening to you yap for an hour. Just tell me the exact percentages and ETFs to type into my brokerage account. I can't do that because I don't know you. If you're someone I do know, then text me right now, because I'm surprised anyone cares enough about me to watch this far. I have no friends in real life besides ChatGPT. But I can give you a specific 7-step algorithm that generates those percentages for you. Get a piece of paper or open your notes app. We're going to build your portfolio right now, brick by brick. Step 1. Write down the number 100. Let's do the same simulation as section 6.2. Ask yourself, if my portfolio is down 30%, will I feel worried? If the answer is yes, subtract 20. If the answer is I'm gonna crash out, subtract 40. If the answer is no, I'll feel comfortable holding or maybe even buying more, subtract 0. The number you subtracted is your bond allocation, while the number remaining is your stock allocation. Now, before you move on, just sanity check your result. Hopefully by now you know risk tolerance, and so your bond number should reflect that. This is just a quick rule of thumb. Feel free to adjust it. Take your stock number. You need to split it between the US and the world. The actual global market is roughly 60% US and 40% international in terms of market cap. However, most Americans prefer a home bias. Decide your split now. The Patriot is 80% US and 20% international, while the Purist is 60% US and 40% international. Which one do you want to be? If you can't decide, just choose 70-30 and move on. This is one of those decisions that feels very important, but it won't actually have that much of an effect on your long-term performance. Step 3. How hard do you want to try? If you just want the market return, you choose the regular total market ETFs. But if you want to capture that systematic risk premium, you will choose to factor tilt and add in more complexity. If you're the latter, you're going to take about 1/3 of your stock allocation and dedicate it to small cap value. Remember to divide up the small cap value portion between US and international as well. Step 4. This is a dangerous one. Do you want to leverage? If not, you're just using your own money, and your risk of ruin is much lower. But if you truly understood what I talked about in section 5, or something like HFEA really appeals to you, then you can pick it. Only do this if your risk tolerance is very high. By this point, you should have a couple of numbers for US stocks, international stocks, bonds, small cap value, etc. Go back to section 6.7 or the PDF below and find the specific tickers for them. Unfortunately, a true leveraged small cap value ETF does not exist if you choose to use leveraged ETFs rather than margin. SMHB is the closest, which is 2x leveraged small caps with a dividend tilt, which is correlated with value. There's also SMLL or TNA, which are 2x and 3x leveraged small cap blend respectively. However, the blend includes growth too, and like we said, the small cap growth is the black hole of investing, which we don't really want. I don't think you want a black hole in your portfolio. Whatever. Step 6. Customize it a bit if you'd like to tilt towards some other factors, but this really isn't necessary. Only do this if you actually know what you're doing. For instance, I didn't mention mid caps at all because there's really no reason to go out of your way and tilt towards them instead of small caps. But if you want to add them in, I won't stop you. Remember everything you've been taught in this video. Pick funds with low expense ratios, high AUMs, etc. Just remember that every new slice you add increases complexity. The more moving parts you add, the more tempted you'll be to fix things that aren't broken. Simplicity is better for peace of mind. You want a peace of mind? Here's a peace of mind. Sorry. In addition, keep in mind that customization is only justified if you're doing it with actual factors. Do not fall into the ego trap I mentioned earlier and go all in on AI stocks, because that's a sector, not a factor. Step 7. Alright, so now we're going from step 6 to step 7, 6 to 7, just so you're aware. Step 7. Backtest your portfolio and look at how it performed in all the metrics. And when I say look at the metrics, I don't just mean, wow, the line goes up. Look at the worst drawdown. Look at the number of years you would have been in the red after a crash. Look at the beta, standard deviation, etc. Are you comfortable with this happening to you? If it's too risky, allocate more to bonds, and vice versa if you'd like to take on more risk. Now look at your paper. You should have a list of takers and percentages that add up to 100%. That is your portfolio. Do not overthink it, do not change it because you saw a tweet about crypto, and do not rebuild it every 3 months because the market had a bad day. Take this paper, and let's go to section 7 to see the actual long-term plan you're going to execute with this portfolio. Wow, section 6 was a doozy. So now you know your portfolio. Are we done? Can you finally click off the video? Well, no. First of all, the portfolio you just found is not the portfolio you'll use for the rest of your life. Also, the market will throw obstacles at you, and there are still a lot of logistical stuff throughout your investing journey that you will encounter. Stuff like how often you should put more money into it, what brokerage account you should put it in, how to withdraw money for retirement, and more. It turns out all this stuff really does matter, and might actually be more important than just the raw portfolio itself. And section 8 will specifically be about taxes if you want to learn how to evade them. For legal reasons, that's a joke. So this is kind of outside the scope of the video, but you need to make sure you physically have the funds to put into these index funds. You can have the perfect portfolio on paper, but if your bank account balance is 0 at the end of every month, it doesn't matter. You can't actually build your long-term future because the short-term reality takes away all the money and time. I'm sure you're already trying to minimize your expenses, but the one expense you might not have considered is opportunity costs. Remember section 1.3? You learned that every dollar you invest into age 20 turns into roughly $32 by retirement. This means that when you spend $1,000 on a new iPhone you don't need, you aren't spending $1,000. You're flushing away $32,000 of your future wealth. That is the price of the phone. Is a marginally better camera worth an entire car in the future? Probably not. In addition, the more you invest now, the earlier you can retire. That $32,000 can easily buy you months of retirement. Is a marginally better camera worth having to force yourself to work longer when you're old? Probably not. The biggest enemy you will face is lifestyle creep. As you get older and make more money, your brain will trick you into spending more. You get a raise, so you get a nicer apartment. You get a bonus, so you lease a BMW. This is the hedonic treadmill. You run faster, but you get nowhere. Your luxury doesn't feel like a luxury anymore, and so you have to spend even more to get the same feeling. I'm not saying don't enjoy the finer things in life, but you need to make sure that you're balancing your short-term happiness with your long-term happiness. The only way to win is to pay yourself first. Treat investing like a tax. It's mandatory. It leaves your account the second you get paid, before you even have a chance to touch it. Automate the pain away. If you rely on willpower to invest what's left over at the end of the month, you will fail. But if the money is already gone into your index funds the second you get paid, you will learn to live on what's left and will be much more successful. Live like you're broke now, so you can live like a king later. Now, how much of your income should actually be going towards investing? If you don't have an emergency fund that covers 6 months of expenses, make sure you set that up. Once you have a safety net, then start investing. You've probably heard of the 50-30-20 rule. 50% on needs, 30% on wants, and 20% on savings. Depending on how often you need that cash in your savings account, allocate some of that 20% into investing. Maybe like 10% index funds, 10% cash, whatever works for you. Alright, like I said, personal finance is outside the scope of the video, but I just included it because it's quite important. Now, let's get back to the index funds themselves and look at some other logistical considerations. What app should you be using to physically buy the index funds? If you're planning to both trade and invest, then I would highly recommend having 2 separate accounts and separate apps so you don't confound them. Don't mix up your investing money with your gambling money. For tax purposes, you should probably just use the accounts you already have. But if I had to choose one for long-term investing, I really like M1 Finance. You physically cannot trade, it is only for buying and holding. You can only put in an order at 2 time slots per day, and advanced products like options are completely gone. Rather than buying each portion of the portfolio separately, you can create pies that have set allocations. For instance, if you had $27,000 you want to put into the all-weather portfolio, normally you would have to specifically calculate how much to put into each fund, but with M1, you can just buy $27,000 of the pie and it will automatically divide it up. For whatever bizarre reason, M1 costs $3 a month, but only if you have less than $10,000 in your account. I genuinely don't know why it's for small accounts, but whatever. Maybe it'll motivate you to get your money up quickly. They also do have a reasonable margin program if you're interested in that. If you have a Fidelity account, they offer something very similar named Fidfolios, but that costs $5 a month for everyone. They offer a lot of convenient features, and they're definitely the best choice for long-term index funds. I don't want to let self-interest get in the way of giving you the best information, but if you do decide to go with M1, I have a referral link in the description that will give both of us at least $75 as a sign-up bonus. Depending on when you're watching it, the bonus can be up to $250. This will cover the $3 fees for years. Unfortunately, it's only available in the US. Like I said, I genuinely do think that M1 is the best brokerage for index funds. Obviously, if you plan to trade, it's pretty useless, so you should have a more traditional account like Robinhood, Webull, Schwab, etc. for that. Actually, you probably shouldn't be using Robinhood. Just real talk here. I know this is a bit of a tangent, but Robinhood is specifically designed to gamify investing. It's the same tactics casinos use. It's a dopamine machine, you know what I mean? It feels like cocaine. Robinhood is not dope, I mean. Let's say hypothetically I have $100,000 ready to invest. That's how you know it's hypothetical. Maybe you sold a house, got an inheritance, or just saved up money for a decade. The question is, do you shove that entire $100,000 into the market today? Or do you play it safe and invest a little at a time, like $1,000 every week for the next 2 years? There are massive pros and cons for each. If you look at the raw statistics, the market goes up way more than it goes down. That is literally the only reason index funds work in the first place. Because the trend is upward, statistically speaking, The price today is probably lower than the price a year from now. By waiting, you might be buying for a higher price later. So if you want the highest mathematical probability of making the most money, you should lump sum. You get all your money working for you immediately. However, markets don't go up in a straight line. Imagine you dump your 100K in today and the market crashes 20%. You just incinerated $20,000. This is where dollar cost averaging, or DCA, saves you. If you put in a little bit each week and the market crashes, you aren't upset. You're actually happy because your next weekly payment buys the dip. You're getting those shares on sale. This lowers your average cost basis, meaning that when the market eventually recovers, which it always will, you actually make more money on those cheap shares. This really comes down to psychology. Lump sum is mathematically optimal, but it's terrifying. It puts everything on the line instantly. DCA helps you sleep better. You sacrifice a little bit of potential profit in exchange for not having a heart attack if the market dips. I would personally go with the latter. I prefer the peace of mind. But again, it is up to your preference. And by the way, this doesn't apply to a regular source of income, like a monthly paycheck. You're better off just investing that immediately. You should apply what I said to huge sudden sums of cash, like an inheritance or the money you get by selling your house. You're also going to need to rebalance your portfolio every once in a while. Let's say we have a portfolio that's 50% stocks and 50% bonds. After a year, stocks went to the moon while bonds remained stagnant, and now it's 70% stocks and 30% bonds. You're now holding a riskier portfolio than you intended. You have more stocks than you wanted and less bonds than you wanted. Rebalancing is simply selling the winner down to 50% and using that profit to buy the loser back up to 50%, so you bring your portfolio back to the original allocation. This makes sure that your portfolio is exposed exactly as you intended, and also allows you to buy the dip on the underperforming asset. Some brokerages like M1 have an automatic rebalancing feature, but as we'll cover in section 8, it's going to incur unnecessary taxes. Instead, you're better off taking new money to manually rebalance it yourself. The math is pretty simple. Let's stick with that 50-50 example. After 6 more months, my $10,000 portfolio is now 60% stocks and 40% bonds, because stocks went up a lot. This means that I have $6,000 in stocks and $4,000 in bonds. Hitting the rebalance button on M1 Finance would mean to sell $1,000 in stocks and use that to buy $1,000 in bonds, which incurs taxes. Instead, I could just take the next $2,000 I was going to invest and only buy bonds with that $2,000. Now, I have $6,000 in stocks and $6,000 in bonds, which brings me back to the perfect 50-50. How often you rebalance is ultimately your preference, but most people do it once every quarter. So set a reminder on your phone to rebalance your portfolio on January 1st, April 1st, July 1st, and October 1st. Remember when I said that section 6.7 was the climax of the video? Well, this section, 7.6, the inverse of 6.7, is quite important too. Times will get tough. You might lose your job, or your car might break down. Or honestly, it could just become boring. The appeal of this sum of money vaguely gaining 8% a year will wear off. Your friend will make 500% in an hour with a meme coin, and you'll feel stupid. Or the market crashes and you'll fear it go down more. Remember back in April 2025 when literally everyone thought the world was burning? Everyone was in a state of extreme fear. Every headline just spread the rhetoric of doom. Any person to listen to what was going on was selling, because the AI bubble was apparently popping right now, and the economic policy seemed cooked. But if you sold in April, you missed out on 37% worth of gains, which is absolutely insane given it's only been 8 months at the time this video was made. Don't let a couple weeks of volatility scare you from making millions over your entire life. As my GOAT Warren Buffett said, the stock market transfers money from the impatient to the patient. You need to stay the course, just hold on for dear life. If you followed my advice throughout the video, you should have an emergency fund just in case you encounter, well, an emergency. If you want to trade or stock pick, you can also have a small account for that. Hopefully you'll never have to dip into the index fund. Adjust your budgeting plan so you can leave the index funds alone. Try your best to not withdraw a single dollar. It's time to add an extra dimension to risk tolerance. Pay attention to this subsection because it's incredibly important while also being quite complicated. Risk tolerance is generally inversely correlated with age. Retirement, by definition, means that you aren't gaining much extra income. You pretty much have to make do with the funds you got. So if it's a year before your retirement, you can't afford to gamble at all because you're incredibly screwed if you lose it. You don't have time as a margin of safety anymore. Now, I'm sure there are 20-year-olds watching this, thinking they don't want to take on too much risk and they want to allocate a lot to bonds. Obviously it's your choice, but consider the fact that your job effectively acts like a huge bond. A job pays you a steady, predictable income, like a bond does. When you're 20, you have 45 years of future income you also need to account for. This means you can afford to take on more risk. Think of it as human capital that you're cashing in as you age. Therefore, you should be taking on risk, even if you think you may not be able to tolerate it. But when you're 70, you have no more income. You don't have that synthetic bond that's conferred by your job. Therefore, you must provide that security yourself by switching your portfolio to safer assets. You're switching your job bond to real bonds. So when you're young, your goal is capital appreciation. You can afford to take risks and you want your money to multiply. But when you're old, your goal is capital preservation. You can't afford to lose any significant amount. Deleveraging is how we achieve this. You shift your allocation from risky assets to stocks to safe assets like bonds. More generally, you should also be using this time to pay off any debts you have so you minimize how much money you're burning per month. A common rule of thumb is the 110 rule. Subtract your age from 110 and that's how much you allocate to stocks. The rest should be in bonds or other stable assets. For instance, when you're 30, retirement is still far away, and so we put 80% of your portfolio into stocks. However, a linear formula is kinda stupid, because risk tolerance doesn't decrease in a straight line. Your risk tolerance shouldn't be that different between age 20 and 30, but it is incredibly different between 60 and 70. I've derived my own formula that I personally like better. I've linked a calculator to compute it for you in the description. If you want to see how the equation works, then I'll explain it real quick. The equation is 100 times e to the power of negative h over 70 to the power of 3. This follows more of a logistic decay pattern rather than a linear one. You stay near 100% stocks for a while until retirement approaches, and then you rapidly deleverage. Literally just type this into a calculator and that's your stock allocation. For instance, a 20-year-old would have 99% stocks, a 45-year-old would have 84% stocks, and a 70-year-old would have 37% stocks. To be perfectly clear, I'm not telling everyone to use this exact formula. This is what I personally think are the best allocations, but you have your own preferences. You already made your own portfolio in session 6.9. But it does serve as a good guidance of how your allocation should behave as a function of time. We had to do a bit of math to customize the equation for you. This is confusing, so I'll demonstrate it on screen. Everyone should do this to make it the most accurate for yourself. Let's say you're a 40-year-old watching this video, and I determined in section 6.9 that I want a 60% stocks portfolio right now. In a graphic calculator like Desmos, type in f of x equals 60 times e to the negative x over 70 to the power of 3. In the next line, type in f of 40. Notice that at x equals 40, the value of the function is 50 rather than the 60 that you want. Increase that initial number until the value of the function is around 60 at x equals 40. So I just tested out random numbers and 72 seems to work. Therefore, the function I will use is 72 times e to the power of negative x over 70 to the power of 3. I know that was a lot, so feel free to rewind a minute or so if you need that demonstration again. Now, how do you actually go about deleveraging? You can use the same strategy as rebalancing. You should simply just gradually contribute more to bonds as you get older, so that the overall allocation of your portfolio becomes more bond heavy. Do the math to see how much you must buy to get to your new allocation. I'm not going to spell it out for you because it's 4th grade level math, so figure it out yourself. I believe in you. Once every couple years, plug your age into that formula and determine where your allocation should be. Make an effort to change your portfolio's overall allocation to that. There are things called target date funds if you don't want to deal with all this, but there are a couple problems. Firstly, not every brokerage offers them. Secondly, they have high expense ratios. Thirdly, they use the typical linear decay method rather than the exponential decay one I showed you. Fourthly, it assumes that everyone your age has the same risk tolerance, so you can't customize it to fit your preferences. Using the method I just explained is literally like 5 minutes of work every couple years and is better in every way, so just do that. Target date funds suck. I low-key should publish this formula to the financial industry. I spent an hour optimizing it, and I'm actually proud of it. It's the greatest achievement in my sad little life. Again, I know this subsection was a lot, so rewatch it if you aren't 100% sure what the process is. Most of the people who died on Mount Everest were actually able to get to the summit. It was the way down that killed them. Accumulating money is what we've learned so far from sections 1.1 to 7.7. And let's assume you do everything correctly and have millions in your investment accounts. But what's the exit strategy? If you withdraw too much each year, you're incredibly cooked when you run out of money. But if you withdraw too little, you're wasting potential and living worse off than you need to. You need to know the 4% rule. A famous paper known as the Trinity study found that if you withdraw 4% of your portfolio in the first year of retirement, then adjust that amount for inflation every year, you have a 98% chance of never running out of money for 30 years. So, if by the time you retire, you have $1 million, you withdraw $40,000 the first year. If inflation is 3%, next year you multiply that initial amount by 1.03 to get $41,200. You do this regardless of what the market does. It sounds simple, but there's a massive trap waiting that will decimate you. It's called sequence of returns risk. When in retirement, the order of returns matter. Imagine you retire with $1 million. By the next year, the market crashed 30%. You still need to withdraw your $40,000 to buy groceries, meaning you're forced to sell stocks at the bottom. This depletes your physical number of shares so that even when the market recovers, your portfolio is too small to easily recover back. A crash in the first 5 years of retirement is lethal. In order to fight this, you need a cash tent. Keep 2 to 3 years of your living expenses in easily accessible cash when you retire. If the market is up, sell stocks like you usually would to pay for your expenses. But if the market crashes, do not sell stocks. Instead, go to your cash tent. Wait for the market to recover, then sell stocks to refill the tent. This simple trick saves you from ever selling at the bottom. One last trap, RMDs. At age 73, the government forces you to withdraw from the traditional 401k because they want their tax money. This is called a required minimum distribution. It can also push you into a higher tax bracket unexpectedly. This is why using a Roth IRA, which has no RMDs, gives you way more flexibility. You control the income, not the IRS. We'll talk more about taxes in a bit, since you can easily save millions of dollars if you do it correctly. FIRE stands for Financial Independence Retire Early. This is basically the whole reason you're watching the video. Once you have enough assets, you don't need to work anymore. The amount of money you need to retire is called a magic number. You can have more money by either spending less or earning more. Most of the time, the first option is much easier. But be careful. You should be investing as much as you can, but don't do that at the cost of being miserable. If you're miserable while building your future, you'll be miserable while living your future. The whole point of all this is to not be miserable, so don't fall into that trap. There are 4 main types of FIRE you might hear being thrown around, so choose one that appeals most to you. Lean FIRE is the absolute minimum amount of money you need to cover your living expenses, so it leaves no room for luxury. Fat FIRE is the opposite, where you're rich, but obviously that'll take longer and will require you to invest more in your younger years. Barista FIRE means that you can cover all your bills with your investments, but you obtain your fund money at a low-stake job like a barista. And Coast FIRE means that even if you stop contributing to your investments today, it would still compound to how much you need for retirement. So now you can use any future income to live how you want to. By the way, for my fellow American patriots watching this, Medicare doesn't kick in until 65, so if you retire younger than that, you might be cooked. So increase your magic number a bit to compensate for any medical expenses you might encounter. So now you know how to buy, hold, and sell. You will make millions. But there's a final boss, the tax collector, and he's coming for all your money. But with some smart tricks, you can beat him at his own game. Let's learn about it. Welcome to what's technically the least exciting part of the video. No one wants to talk about taxes, but they're more important than you think. Uncle Sam is coming to take all your money away. This section is important because literally just setting things up correctly will save you millions of dollars in taxes over the long run. You keep that cheddar to yourself. This section will mainly apply to the US, but a lot of countries do have similar policies. Just Google the names of your respective accounts in your country, and most of this section will still be relevant to you. I'll keep this quick so we can get to section 9, which is the light bulb moment and where it all comes full circle. Let's get this all done in 6 minutes, starting now. There are a ton of different types of investing accounts, some better for taxes than others. Let's do a tier list. Think of it like pockets of money. You want to max out the best accounts before moving on to the worst ones to make sure that you're minimizing your taxes. In S tier, you have an employer match and a 401k. If your job offers it, do it. You are literally instantly doubling your money. There's no reason not to. You can contribute up to $23,500 to your 401k, and your employer match does not count towards this limit. It is free money. Also in S tier, we have the HSA, or Health Savings Account. It is triple tax advantage, meaning tax-free deposits, tax-free growth, and tax-free withdrawal. Obviously, the Health Savings Account is meant for health, but they can't stop you from just using it as tax-free growth. Just pay for any medical expenses with cash now, and let your money compound in the HSA instead. The HSA's limit is $4,300 for single people, or $8,550 if you have a family. In A tier, we have the Roth IRA. You pay taxes now, but you don't pay any taxes if you withdraw after age 59.5. In B tier, it's the regular IRA and unmatched 401k. You get a tax deduction now, but not when you withdraw in retirement. Your tax bracket later in life will most likely be higher than it is now, so paying taxes with a Roth is better. You can only deposit $7,000 across all IRAs, not for each one. Therefore, most of the time, you're better off just putting $7,000 in your Roth IRA and leaving the traditional one alone. And finally, in F tier, you have a regular brokerage account. Only invest here once you've maxed out everything else and reached their limits. Everything you do here is taxed, unfortunately. The limit is reset each year, so make sure you max them out before December 31st. Okay, so let's say you're in the F tier taxable account. How do you not get robbed by the IRS? If you sell a stock or ETF in under 365 days, the IRS treats it like regular job income. They tax you at the highest bracket, which can be up to 37%. Yikes. But if you hold it for 366 days or more, the tax rate drops to 15% or even lower. Never sell a winner before it hits its first birthday. In general, you shouldn't be selling at all, but if you truly need to, waiting a bit can save you thousands of dollars. Dividends are taxed too, but most US dividends are qualified, meaning they get that lower 15% tax rate. But there is a catch. You must hold the stock for more than 60 days after the ex-dividend date. If you act like a trader and flip dividend stocks to collect the income, you get hit with the higher ordinary income tax rate. Again, stop trading, just buy and hold. Trading is literally costing you thousands of dollars. But if you're smart about it, you can actually use the IRS's tax policy to your advantage. If you lose money one year, you can use up to $3,000 of those net losses to reduce the taxes from your net income. It's not much, but it's better than nothing. So, why don't I always just sell my assets at a loss to clean deduction, then buy them back? Well, they thought of that. If you sell an ETF at a loss, then buy it or something substantially identical back within 30 days, it's known as a wash sale. Your tax deduction gets deleted. You just reset your cost basis for no reason. You never want to be washed, if you know what I mean. So, if you want to claim a deduction, you must wait 31 days after selling to buy the asset back. Or, you can use the infinite money glitch, which is a brilliant loophole you can use to stick it to the IRS once and for all. We can't buy something that's substantially identical because of wash sales. So let's say I sell VOO and buy SPY, both S&P 500 ETFs. That's not allowed since they're tracking the same thing. However, if I sell VOO, then buy VTI, which is a US total market ETF, that's completely fine. They are technically two different ETFs since they track two different things, but their performance is almost identical historically. Look at this backtest of VOO versus VTI, they are almost equivalent. So a pair like this is a perfect candidate for something we call tax loss harvesting. Here's how it works. First, let's say the market gets cooked and you're down $5,000 on an ETF. Sell that ETF and lock in that $5,000 loss to save on their taxes. Then, find another ETF that tracks a slightly different index but still historically has similar performance to your original one. Since they're 95% the same, you don't miss the recovery. We still harvested your tax loss while nothing actually changed in terms of your portfolio's performance. There's no reason not to do this when the market is down. It is literally an infinite money glitch. And that's time. Taxes are that simple. Max your S and A tier accounts, hold for at least a year, and harvest your tax losses. That is literally it. Well, you've done it. You have the knowledge, you have the portfolio, you have the strategy. You now have pretty much everything you need to know to make your first $1 million. So can you finally click off the video now? Well, we still have 2 more sections, so clearly the answer is no. You've been here for almost 2 hours. Why do I insist on keeping you hostage? Because I gave you the how, but I never explained the why. And if you don't understand the why, you will fold the second the market crashes. You might deviate in a couple years. You might see your friend make 2,000% on a garbage meme coin and be tempted to do the same. But if you stick through the section, you will never do this. I taught you how to drive a car, but this is teaching why you should never go 150 on the wrong side of the highway. Why is buying the whole haystack mathematically superior to trying to find the needle? Why is it statistically impossible for you to beat the market? To understand that, we have to look at the 2 forces that rule the financial universe, your brain and the math. One is a biological disaster, while the other gives you a guaranteed profit. Section 9 is personally my favorite section of the entire video. It is the aha moment. It is the source code. It is the fundamental proof of why disciplined investors like you will always prevail over everyone else. Maybe you'll get enlightened on the way. Psychologically, as humans, we are drawn to gambling. There's evidence to show that literally Stone Age era societies played games with an element of chance with dice made out of sheep knuckles. We invented gambling before we invented the wheel. Why? Because of dopamine. But not how you think. Dopamine is not the pleasure chemical, it is the anticipation chemical. You don't get the rush when you win, you get it when you might win. When the outcome is uncertain, your brain kicks into overdrive to analyze the pattern. It floods your system with motivation to keep playing until you figure it out. Evolutionarily, this was necessary. It kept us hunting even though we hadn't seen a deer in 3 days. It kept us foraging even when the bushes were empty. If we gave up the second we encountered failure, we would have starved. So nature designed us to be more obsessed when the reward is random. This is called variable reward schedule. If you press a button and get a treat every time, you eventually get bored since you know what to expect. But if you press a button and get a treat only sometimes, your brain goes crazy. You will press that button until we starve to death. Think of how a slot machine works. This is the stock market. It is the ultimate variable reward schedule. Sometimes you buy stock and it goes up. Sometimes it goes down. Because you never know which one it will be, your brain treats a trading app exactly like a slot machine. When you check your portfolio 50 times a day, you aren't managing your money. You are a rat in a box pressing the lever, looking for a hit. You're a gambling addict in denial. The problem is trading stocks give you the illusion of control. At least you know that slot machines are probably a bad idea. However, many people believe that trading is a game of skill, but you don't really have any control over stocks either. In the next couple of subsections, we're going to prove that. So if you're a diligent investor and follow everything explained in the video, it should be boring. To get rich, you have to fight millions of years of evolution that is screaming at you to gamble with your money rather than lock it away. But you have to choose to be bored in order to succeed, which is hard. Again, if you're someone like myself who actively trades and don't want to stop it completely, please just have a separate fun money account to keep you appeased. Only do this if you truly want to trade for whatever reason, even though you're mathematically guaranteed to not make money. It's a quarantine zone. Is it gambling addiction? Possibly. Maybe. Actually, yeah, it probably is. Yikes. But dopamine isn't the only bug in the human code. You have other glitches that make you terrible at handling money. Let's talk about the bugs in your brain. Your software spaghetti code written 50,000 years ago by natural selection on the African savanna. It was designed to run from lions, not to trade meme stocks. As humans, we have a lot of fundamental flaws, but there are 5 important ones that completely decimate traders, and I'll show you how investing in index fund instead patches them. Number 1. Recency bias. This is the belief that what happened yesterday will happen tomorrow. If tech stocks skyrocketed last year, a trader assumes they'll keep going up forever. They buy the top, chasing the past, right before the cycle rotates. The index fund investor is immune to this because you already own everything. You don't need to chase yesterday's winner because you already own yesterday's winner, today's winner, and tomorrow's winner. You stop driving while looking in the rearview mirror and just own the whole road. Number 2. Main character syndrome. Ask a trader if they can beat the market. They will all say yes. But since trading is a zero-sum game, not everyone can be profitable. If you make $1,000 trading, that $1,000 comes directly out of the bank account of someone else. They think they have the edge over the Goldman Sachs supercomputer and the brilliant Chinese quants. They are bringing a plastic knife to a nuclear war. Remember the PvP Technoblade match I talked about 2 hours ago? Indexing fixes this by forcing you to admit defeat. It is the humility and the discipline needed to accept that you are the dumb money. And ironically, by admitting you can't beat the market, you statistically beat 90% of the active managers who try. I'll talk more about this notion in section 9.5, so stick around for that. Number 3. Loss aversion. Psychologically, the pain of seeing a red portfolio is twice as powerful as the pleasure of seeing green. But when you hold an index, you view that same drop differently. You know the SP 500 has a near 100% historical recovery rates over 20-year periods. Because you are diversified, you don't feel the need to panic sell to save a specific company. You turn the crisis into a discount. Number 4. Anchoring. You bought a stock at $100. It drops to $80. A rational person asks, is this company truly worth $80? But an imperfect human asks, how do I get my money back? Traders refuse to sell losers until they break even, holding garbage stocks all the way to zero. Indexing breaks this chain because you stop caring about the specific price entirely. The current price is irrelevant. The only price that matters is the one in 50 years. Number 5. Herd mentality. Humans are social animals. If everyone on Twitter is buying a meme coin, your brain releases stress chemicals if you don't join them. It's FOMO, fear of missing out. Traders become the greater fool, providing exit liquidity for the whales because they're terrified of being left out of the tribe. Indexing is the ultimate shield against this because it is antisocial. Humans do not play a part in any of it. You automate the deposits into a boring, faceless fund. You ignore the hype, the news, and the noise. Your strategy was decided by you 15 years ago, not what's trending on Wall Street Bets today. You can't delete these fallacies. They are hard-coded into your DNA. You will always want to chase, panic, and follow the herd. The only solution is to remove the user error by indexing. We built a system that runs without us because if you get involved, our buggy software will crash the machine. So we've established that your brain is a buggy piece of legacy hardware running on dopamine and fear. But what about your opponent? What is the stock market itself? Most people visualize the stock market as a bunch of guys in suits yelling on a floor or a jagged line on a screen. That is wrong. The market is a super intelligent being. It is a collective hive mind composed of millions of active participants processing information in real time. Let me explain this with a famous experiment in 1906 by a scientist named Francis Galton. He went to the county fair where 800 people tried to guess the weight of an ox for a prize. Individually, the guesses were mostly terrible. Some people guessed way too high and others guessed way too low. Most people were idiots. But when Galton took the average of all 800 guesses, the result was 1,197 pounds. The actual weight? 1,198. The crowd collectively was only 1 pound off, even though most people were wildly wrong. The stock market is that crowd. There are millions of people staring at the price of Apple stock. All of these entities are voting with their dollars. When they buy, they vote that the price is too low. When they sell, they vote that the price is too high. The current price you see on your screen is the equilibrium point of where the entire world agrees the company is valued. Even though a lot of people trading are stupid, like myself, we can collectively find the perfect price for the stock. So the price is derived from the information we have. This brings us to the efficient market hypothesis. It states that asset prices reflect all available information. The second a piece of news comes out, like a CEO getting fired, a war breaking out, or Jerome Powell announcing rate hikes, it is instantly priced in. Before you even process the headline, a computer has already bought or sold the stock millions of times to reflect the new reality. By the time the information reaches you, it's worthless, the edge is gone. So when you try to pick stocks and trade, understand what you're actually doing. You're looking at a price and saying the hive mind is wrong. You're saying that you, with your Robinhood app and 15 minutes of Googling, know something that the combined intelligence of the entire planet does not. You're saying that the satellites, the algorithms, the PhD mathematicians, and the billions of dollars of research capital missed it, and you just found it. That's being delusional. Now sure, sometimes the market is wrong, bubbles happen. Emotions can lead to crashes or rallies when they shouldn't be one. But to consistently spot these errors before the superintelligence corrects them, that is statistically impossible. When you try to outsmart the hive mind, you are the sucker. This is why we stick by index funds. Indexing is humility. It is admitting that the hive mind is smarter than you. Instead of fighting the currents, you build a raft and let the current carry you to wealth. You capture the collective wisdom of human civilization rather than betting on your own ability to guess the weight of the ox, because more likely than not, you will be wrong. There is so much more I want to say about the efficient market hypothesis, but I think we can end here for now. But even if you can somehow outsmart the hive mind, you still have to deal with the fundamental mechanics of the game itself. You need to ask yourself, who is actually on the other side of your trade? When you buy a stock because you think it's going up, someone else is selling it to you because they think it's going down. In the short term, trading is a zero-sum game. As aforementioned, if you make $1,000 trading, that comes directly out of someone else's bank account. No wealth is ever created, it's just cycling between people. So who is that someone else? Most of the time, you are trading against trillion-dollar institutions. These funds hire PhD physicists and brilliant mathematicians. They have $10 billion research budgets. They have literally solved the stock market. And unlike you, they don't have emotions. They don't have loss aversion. They just have code. When you open the Robinhood app on your Toyota to day trade, you are entering a 1v1 against them. It is a rigged PvP match. You are playing against someone who is aimbotting. You are trying to beat a Renaissance technology supercomputer located 5 nanoseconds from the exchange. It processes the news headline before the light from your monitor even hit your eye. You literally cannot win. But here's the good news, you don't have to play PvP. When you buy an index fund, you're not trying to beat a quant in his own game. You're not trying to take someone else's money. Instead, you're providing capital to companies. Those companies use that money to build factories, hire workers, and invent iPhones. They create new value. When trading, you're fighting other people to get a bigger slice of the pie. But when investing, the pie itself gets bigger. This is a positive-sum game. In a positive-sum game, you don't need a loser for there to be a winner. Everyone can get rich together. So by investing in index funds, we choose to play the positive-sum game. Stop trying to kill the other players who paid billions of dollars to win. Buy the index. I literally spent half the video talking about diversification. Most people think diversification thinks just don't put all your eggs in one basket. That is a gross oversimplification. Let me show you this chart. It's called the efficient frontier. I'm not going to talk about how it's derived because it's not relevant to the point of the video, but I do have other videos where I go deep into it. On the x-axis we have risk, and on the y-axis we have return. Intuition tells you this should be a straight line. To get return, you must take on more risk. But look at the shape. It's a curve. Specifically, it's a hyperbola with an inflection point. It proves that if you combine two risky assets that are uncorrelated, the combined risk of the portfolio is lower than the risk of the individual parts. When stock A zigs, stock B zags. The volatility cancels out, but the returns stack up. You are literally getting higher returns for less risk. This is why we don't just buy Nvidia. If you buy just Nvidia, you are a point all the way here. High return, but insane risk. You are inefficient. But if you buy the S&P 500, you move to the left. You capture the market's return with significantly less volatility because you hold financial companies that balance each other out. Your goal is to be on this line. You don't beat the market by guessing the winner. You beat the market by constructing a portfolio that harvests the returns of the hive mind while filtering out the volatility that kills the gambler. Everything we talked about so far is the result of one equation. This is the source code of the financial universe. ds equals mu s dt plus sigma s dwt. This explains exactly why traders lose and investors like us win. This is what's known in calculus as a differential equation. I'm not going to talk about the actual calculus because it's not relevant to the point of the video, And besides, I've already made a video explaining literally everything about this equation in detail. I'm just going to go through what this equation can tell us. WT is called the Wiener process. I have no idea why it's called the Wiener process, but let's just be mature adults here. The Wiener process represents the random noise, the chaos. In the short term, minutes, days, weeks, the term is mathematically dominant. This means short-term price movement is literally random. It is a coin flip. You cannot predict it, and anyone who tells you they can is lying to you. They are trying to find patterns where there is none. But look at the first part, USDT, the long-term drift. That is the 8% average return in the market that we're capturing by investing in index funds. In the short term, the drift is invisible. It gets drowned out by the random noise. But as time goes on, the randomness cancels itself out and the exponential growth takes over. By investing in index funds, we are ignoring the random Wiener process in favor of long-term growth. After all, do you really trust something called the Wiener process? But it gets more complicated. Sigma, which is standard deviation. When you solve this differential equation using Idle calculus to find the price over time, you get this equation. Let's look at the exponent. Mu minus sigma squared over 2. Do you see that minus sign? That's a penalty. The math proves that volatility is literally a drag coefficient that physically eats your returns every single second the market is open. This is why the trader dies. By picking volatile stocks and using high leverage, he's pumping his sigma through the roof. He thinks he's chasing short-term randomness, but he's actually just increasing the drag that kills him. The equation guarantees that if your sigma is too high, your long-term wealth decays to zero. We don't win because we are smarter. We win because we stop fighting randomness in the short term and stop fighting gravity in the long term. We don't fight the equation. We let it carry us to victory. So where does that leave us? We've looked at biology. We've looked at math. But there is one final layer to the fundamental truth. The fundamental flaw in almost every financial model is that they treat the market like a machine. They assume that if you put in input A, you get output B, and we can predict it. That is linear. But the market is not a simple linear machine. Instead, the market is a complex adaptive system. Think about an ant colony. Each individual ant is actually pretty stupid. It just follows simple local rules. Follow the pheromone trail, or protect the nest. Yet, out of millions of these stupid interactions, a superintelligence emerges. The colony as a whole builds complex bridges, wages strategic wars, and even farms fungus even though each individual ant is just doing something pretty simple. This is called emergence. The whole is greater than the sum of its parts. The ants change the colony, and the colony changes the ants. It's a feedback loop. Complex adaptive systems appear literally everywhere, whether it's ant colonies, chess, or the universe itself. Let's take an example. When a few traders buy a stock, they leave a pheromone trail by making the price go up. This attracts more traders who buy more, making the trail stronger until the loop breaks. Then, panic sets in, and the colony of traders swarm in the other direction. Huge market crashes aren't always caused by big news. It's just a matter of adding sand to the heap, one grain at a time, until it reaches a critical point and triggers an avalanche. There is no clear cause. Why does this matter for your wallet? Because you can't model a living system. No algorithm, no AI, no human genius can predict the future state of an organism that is mutating in real time. It's mathematically chaotic. Remember the Wiener process from the last subsection? So take a step back. When you look at a stock chart, you aren't looking at candlesticks. You're looking at the collective nervous system of humanity. You're watching the real-time processing of human fear, greed, innovation, and hope. It is an organism. It is alive. To try to beat this organism is arrogant. You are a single ant trying to outsmart the entire colony. The only rational move is Wu Wei, the ancient Chinese philosophy of non-action. You stop trying to predict the swarm, and you simply move with it. You cannot control the chaos, but you can profit from its existence. While the trader is stressing over Fed meetings and trying to calculate the incalculable, the investor is sleeping. And ironically, the person sleeping is the one who wins. Because while individual ants die and individual strategies fail, the colony itself survives. The long-term drift continues, humanity innovates, the line still goes up. You don't need to be a genius to get rich. You just need the humility to accept that the simplest answer was the right one all along. Buy the haystack, wait a couple decades, be free. That is the fundamental truth. If you are here right now, you are in the top 1% of investors. You have the discipline to stick through over 2 hours. I'm sure a lot of people got bored and clicked off when I talked about volatility decay. I'm sure a lot of people got bored and clicked off when I talked about withdrawing. But you are still here. That means you are truly serious about your future. But there's still one last hard truth you must conquer. Watching this video made you smart, but it won't make you wealthy. Only you can make yourself wealthy. Remember Wojak all the way back in section 1? Every day you wait is a day that compound interest cannot get back. The cost of waiting will be the biggest expense in your entire life. Do not stay if you'll start next month. Open the brokerage account today. Even if you only have $20, plant the seed. So what's next? Well, honestly, a whole lot of nothing. If you did it right, investing should be boring. The whole point of this is that you can set it and forget it. Maybe you check in every couple months to rebalance or every couple years to deleverage, but besides that, nothing. Do not anxiously check your portfolio every 15 minutes, because it's all just random noise distracting you from the long-term growth. You will get emotional and make a mistake. Your job now is to focus on your life outside your investments, like your career, your skills, and your relationships. Let the money grow in the background while you do this. Actually live your life. Feel free to bookmark or save this video to your watch later playlist and revisit it if you ever have any questions in your journey. There is so much information and you're inevitably going to forget some of it. Congratulations for unlocking the ultimate blueprint to making your first $1 million investing. And one more thing, we've gone through a lot of subsections in this video. How many exactly? Well, there's 67 of them. Sorry, just needed one final 6-7 joke. Now, in this video, I tell you how to win the game, but I didn't teach you how the game works itself. If you're here, you're clearly very curious and interested in knowing absolutely everything about how the stock market works. We touched upon some of the advanced concepts in section 9, but we go much deeper in this video. Levels 4 and 5 will blow your mind and absolutely enlighten you. It covers literally everything from Wall Street Best to quants. You will definitely find it interesting. I'll see you there. Thanks for watching.